We detected an unusual trade worth $3.5 million on Wells Fargo stock, ticker symbol WFC. But here's what makes this even more interesting. The stock just reached an all-time high. And if you've been following our channel, you'll remember the last time we posted a video on Wells Fargo was back on this day, April 16th, when the stock was trading near its lowest level of the year. This was the video we shared on our channel on April 16th, where we analyzed a $145 million options trade to help determine whether it was the right time to buy Wells Fargo stock. And after analyzing the data, it was clearly flashing a buy signal. So we entered our trade going long bullish, following the trades of a wealthy investor whose activity stood out. And as it turns out, that analysis was correct and highly profitable because Wells Fargo stock is currently trading at all-time highs. And so, how profitable was it? Well, you can see that from April 16th, when it was trading near its lows, to its high now at around $83 per share, this is about a 28% gain if you were trading the stock itself. But because we traded options instead of just buying shares, our returns were even higher, thanks to the leverage options provide to amplify gains. And so, how much higher was it? Well, if we take a look back using the historical data from April 16th, you can see that those May 16 options being traded at the 67.5 strike calls were priced around 137 per contract. When we analyze the unusual option activity of 28,000 contracts, which spiked the volume up significantly. And when those options expired on May 16, you can see that the 67.5 strike calls were deep in the money because the stock went up a lot, and they were worth between the bid price of $790 to the ask price of $900. So it clearly increased by a lot more in value. And remember, this shows options prices, and since each options contract controls 100 shares of stock, we multiply by 100 to get the dollar value, or simply move the decimal 2 places to the right. And so to calculate the gain in options, we first get the average between these two prices, $790 plus $900, divide by 2, which is $845, and then we subtract the initial entry cost of $137, which equals $708 of profit per contract. And now we divide by the initial cost of $137 and multiply by 100 to express this profit as a percentage, and we get a 516% profit. And so that's how trading options in this, based on our analysis, gained a lot more than the 28% from just trading stocks. So if you want to learn more about how we analyze this unusual trade to make 516% profit, we'll put a link to this video up here. Don't forget to subscribe and hit the notification bell so you don't miss these profitable trades. Now, with that being said, even if you're subscribed to our channel, you might still miss out on some of our most profitable opportunities. That's because we don't always have time to make a video. Most of our time is spent analyzing data for the exclusive trades we share inside our membership, and we email that analysis to our paid members. For example, just a few days ago, on July 1st, we entered a trade on Wells Fargo after analyzing these September 19 options at the 87.5 strike calls. POS stands for our position, and the green color indicates a buy position. This was the email we sent to our members when we detected unusual option activity on July 1st. As you can see, we analyzed Wells Fargo, or ticker symbol WFC, and went long bullish when the stock was at $81 per share, because 26,000 contracts of these September 19 options at the 87.5 strike calls were being traded at a price of $164 per contract. And notice how we could sell them at a higher price now, $241 per contract. So it's already a profitable trade. And so if you want to start getting full access to all of these profitable trades and want more time to act on these opportunities, consider joining the membership on our website. We'll put a link here where you can see in real time when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, if you missed out on all these profitable trades on Wells Fargo, you might be wondering, is it too late to get in on Wells Fargo now that the stock has hit an all-time high? So let's analyze the most recent unusual trade we just detected to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, at first glance, nothing stands out. That's because wealthy investors don't always want us to see what they're doing, so they break their trades down into smaller quantities. But our system can still detect something unusual beneath the surface, so we filtered out the noise, removed all the other expiration dates, and focused in on the December 19 options. And now we can see more clearly that on July 3rd, there were a series of trades all targeting the 85 strike calls that expired December 19. And we can see that these same call options were being traded multiple times, and they were also being traded at roughly the same price, around $590 per contract. And so we can calculate the total cost this wealthy investor spent by multiplying the price per contract by the total number of contracts traded. And so, how many contracts did they trade? Well, let's dive deeper into the option chain to take a closer look at these December 19 options, specifically at the 85 strike calls. As you can see here, the volume spiked significantly up to 6,000 contracts. And so, to estimate the size of this unusual trade, we multiply the 6,000 contracts by the price shown earlier on the options time and sales tape of $590 per contract. And this equals a total value of approximately $3.5 million for this unusual option activity. But keep in mind, just because a trade is large does not necessarily mean it has a high probability of success. In fact, this one carries more risk than the smaller, more selective trades we share on our website. And so if you want to get access to the lower risk trades with a higher probability of profit, then go to our website. We'll put a link up here. And with that said, even though this trade carries higher risk, we still took it, but we used position sizing to manage our risk. As you can see here, at the 85 strike calls, since this was a new opening trade, we also traded these call options and got into the same position here. Now, how did we know these were new opening trades? Well, notice that these options have an open interest of 1,900 open contracts, which is less than the 6,000 contracts being traded. So it would not be possible to close 6,000 contracts if only 1,900 existed before. That tells us this wealthy investor was opening new contracts and not closing out contracts. And that's a key detail, because if a wealthy investor is closing trades, it tells us they're concerned or cautious, a signal to stay out. But if they're opening new trades, it signals an opportunity and a reason for us to pay close attention. We always take this extra step to analyze the data at a deeper level, because many other websites and scanners don't. They report all high volume unusual trades without filtering out closing trades, which leads to wrong results and losses for those following unusual option activity. And that is why we have more winning trades than other websites. And in this case, our deeper analysis confirmed it. This was not a closing trade. This was a new trade opened by a wealthy investor. So with that confirmation, we followed the smart money and bought the same call options for about $5.90 each, the same price we calculated earlier. And so when we analyze this trade, You can see here on the risk profile graph where the profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line over here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, as the share price goes down, this trade becomes more negative loss. And as the share price goes up, this trade becomes more positive, more profitable, because it's going long bullish on Wells Fargo stock. We can also confirm that by checking the options Greeks. This trade has a positive delta, which means it's positioned long and bullish. If it was a short bearish trade, we would see a negative delta instead. But keep in mind the risk with this trade. It has a negative theta, which means it loses value over time due to time decay. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $85, the stock needs to trade above $90 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here, where you can also learn more strategies to boost your profits. And if you missed our previous analysis on Wells Fargo, we'll link that as well so you can see exactly how we made over 500% profit on that trade. Let us know in the comments, do you think Wells Fargo will keep going higher or drop lower? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.